Companies Act. A special presentation by The Firm.
Last week on Companies Act, we navigated through the differing definitions of subsidiary, consolidation of accounts, mandated year endings, revision of financial statements, board reports, directors' responsibility statements, and internal financial controls.
The law is defined it as internal financial controls, and it talks of even orderly and efficient conduct of the business.
Yeah.
That is too sweeping.
This week, we shift focus from Chapter 9 to Chapter 10, Audit and Auditors. One of the big new provisions in the Companies Act 2013 is Auditor Rotation. All listed companies, unlisted public companies with a paid-up share capital of 10 crore rupees or more, private limited companies with a paid-up share capital of 20 crore rupees or more, and all companies with a public borrowing of 50 crore rupees or more must rotate their auditor or audit firm. A company can appoint an audit firm for up to 2 consecutive 5-year terms. Any further reappointment can happen only after a gap of 5 years. This tenure limit applies retroactively, and companies have up to 3 years to comply. The law also applies several safeguards. An incoming audit firm cannot have any partners common with the outgoing audit firm. An incoming audit firm cannot belong to the same network as the outgoing audit firm. And if the certifying partner joins another audit firm, that audit firm becomes ineligible for a period of 5 years.
Practical applications of audit rotation.
Yeah, now that the principle is accepted, if you look at that provisions in isolation, it is practical to deal with it. But when you apply it alongside the provisions of scope of services, etc., the independence rules, it becomes a challenge when you actually start rotating. Because as you rotate auditors mandatorily, you need to be able to find auditors who are independent of the entities to be able to appoint. And in this term of 5 years, you are rendering services. Other audit firms are rendering services.
Non-audit services.
Non-audit services. Yeah. And that could trigger the issue of independence. The second point in relation to the practice, while all these safeguards have been there to deal with network firms.
But that's really not a company problem. That's an audit problem, and that's particular to a few audit firms problem. Not all audit firms offer consulting, etc.
The company problem is different. The company problem is different. Just as we discussed for consolidation of accounts, we are talking of a joint venture abroad or a subsidiary abroad. Imagine a company which has 300 subsidiaries across the world. How will you rotate auditors? Will you do it all at the same time? Coupled with the auditing standard SA 600, which requires India has carved out to some extent, but which in a way, if you want auditor to take ownership for consolidated financial statements, he will insist that he has oversight on all the 300 subsidiaries which which is being consolidated. So the rotation dimension is always a challenge for global entities. It is also a challenge for Indian subsidiaries of foreign multinational entities, both ways. Indian entities having a global footprint, global entities having an Indian footprint. Whilst the principle is right for listed, in extending it, one should have had some carve-outs.
I'm going to go to Mr. Rao on this. Do you see the problem the way Mr. Ramesh sees it, or is he seeing it from a unique network firm point of view? And are you saying that you don't have an issue with 300 subsidiaries, audit rotation in all subsidiaries, parent company, intermediate level, that's all fine?
No, auditor has to understand the business. Of course, now it has become a law that you have to rotate the auditor. So there's nothing else which we can do except changing the auditor. So when we have to change the auditor, do we have any practical problems in changing the auditor? I don't think so from the business point of view.
I think you can't wish away the fact in a global setup that it's not easy to change auditors, particularly when 10 years is not necessarily a long period in today's environment. Even the EU that you referred to earlier as following our example is a 20 years, a 10 plus 10. And if you do a joint audit, it's 24. So after a lot of discussion, even that realized that, look, you need a sufficient period of time for the auditor to be in there. But having said that, I think companies will get used to it, auditors will get used to it. The one challenge which I think in practice that's coming up is unlisted companies. Because
I think that's one question could have been asked, saying, could we have started just with listed and then over time seen how it works and then moved on to unlisted and private companies?
Correct. And I think the problem gets compounded for multinationals, because think of a Dutch company, okay, which has got subsidiary in India, 100% subsidiary in India. They need to manage their own rotation requirements in the context of 12 years or whatever they are doing, and then they look at India and try and deal with the rotation rules in India.
What's the big problem?
No, it is a problem, because they will change their auditor at the parent level after the 12-year period, while they will have to change their auditor in India after a 10-year period.
So
no, so it is becoming, and that compound,
why is it an issue?
Because prohibited non-audit services rules also come in relation to
so
what you can, you cannot.
So maybe people will move from doing consulting work with Deloitte, KPMG, EY, PwC to doing it with BCG and all the non-audit firms.
Yeah. Doing it with PKF also.
Sorry. In practice, we are seeing a lot of concern. So, for example, think of GE if it has to rotate out. Okay, I'm just giving an example. In India, from its global auditor to another firm. Now, that same firm may be doing non-audit services which are prohibited across the world for GE, and therefore many firms will be prohibited out just because of that relationship. And I think that these are practical issues which we are not dealing with. These are the GEs of the world will deal with this problem.
Very surprisingly, none of the industry associations took this as an issue. At the time of the rulemaking, while there were several representations which came, none of the industry associations took it up as an issue and said, independent directors, they said we wanted prospective.
Yeah.
That's something which you should keep it at the back of your mind. Second is, rotation is nothing new to us. State Bank of India, all banks, all insurance companies,
I get it.
All government public sector Navratnas have been undergoing. I've never found issues in quality of audit.
But Mr. Rao has admitted that private sector companies don't see a big practical issue either as yet.
That's why I said I'm expressing my personal view. I'm not here to represent the institute on its view. I only said the rotation has been there. We should either take a consistent stand that rotation is needed. You can't say government companies will have rotation, banks will have rotation, insurance companies will have rotation, but private sector, no, I won't take rotation, will be not a right argument. You have to take one consistent view.
I'm not even arguing in favor or against rotation. I'm saying it's here. Some of us welcome it, others don't for practical reasons that pertain to their specific areas of profession. I'm saying, what is the impact of this?
In my view, the overall requirement would be about 100 companies. I think a country of our size, if it cannot produce 100 companies, 100 chartered accountant firms, who can do this? And large or medium, as long as their capability is enough. Because the company is not worried about the size. Company is worried about what quality of service I will receive.
Yeah, but also large companies require a large number of...
Large, agree. Yeah. But if you think a country of our size cannot produce 100 chartered accountant firms, I'm not able to agree.
But we don't have them now, do we?
No, I think we have.
Okay, I have a question saying, if you've been an auditor who has completed 2 terms of 5 years, which is the maximum term, with let's say a holding company, can you then become the auditor of the subsidiary company in the the 3rd term, or you're barred from that?
I don't see any restriction.
You can, right?
You can.
So you're never going to run out of firms either, Mr. Rao.
In my view, there is no restriction.
There is no restriction. He's right.
Yeah. So then you're not going to run out of firms either.
There's no problem at all.
There is no problem at all. So this we are all just beating our chest for no reason.
My view, I don't know.
Time will tell us whether it's a issue or not, but we have to deal with it.
All I'm saying is, whoever is big, let's say outside India, and he has a subsidiary here, it has to be audited by the same auditor if you want the parent company auditor to express an opinion on the consolidated financial statements. That's the auditing standard internationally. So irrespective of whom you appoint in India, it will still have to be audited
and I think
by another firm. So it means 2 auditors for the company,
and I think
twice over for the same period.
That is exactly where the company's practical problems comes in. From a multinational perspective, people will have to deal with 2 auditors, and frankly, from our perspective, it only doubles the market for us, if that's the way you want to look at it, because you'll have 2 audits for the same company.
Okay, you mean the Big 4 win anyways, is it? Either way.
You said it.
Companies Act, a special presentation by The Firm.
The new company law introduces new criteria for auditor disqualification. Some vague, others tough to comply with. For instance, a person or firm who directly or indirectly has a business relationship with a company or its subsidiary, holding or associate company cannot be its auditor. Thankfully, the rules clarify that permitted non-audit services and commercial transactions in the ordinary course of business and at arm's length are not included within the definition of business relationship. So, if an auditor buys airline tickets from an airline, such a business relationship is not a disqualifier. But Section 141 also says that a relative of an auditor should not owe the company more than 5 lakh rupees and cannot hold securities of the company of more than 1 lakh rupees in face value.
The real issue is on relative. Because an auditor's relative cannot hold securities beyond a certain limit, cannot be indebted, cannot provide a guarantee, etc. The challenge is the principle of dependence has been done away with. Now, I can only control persons who are dependent on me. Otherwise, it's impossible for me.
So, my question was this,
on a
right?
daily basis
so
to
does
determine.
this only apply to the audit partner working on that particular audit? So, it's only his relatives who are barred from holding anything more than 1 lakh in face value of the shares?
It doesn't seem to be so.
Or does it apply to all the relatives of all the partners in that audit firm who is doing it?
All the partners.
All the relatives of all the partners.
And there are 9 levels. Even if I had 1 in each level,
9 levels
that
of
would
relatives.
be 9. So if I have...
Not 9, 7, no? We've come from 14 to 7.
No, 15 to 9 in a way.
Okay, so...
You know. But and if you have more, then and more partners, then you can see the dimension. And you are seeking information almost on a daily basis. How would you operationally comply with?
That's a fair point. How do you? This is just impossible to comply with. I would think that you'd agree with that.
I think it's a big issue, and which is why globally, once again, you apply to financially dependent relatives.
Let's assume you had a stepfather and you wrote to him saying, please give me what are the entities in which you have invested in. Is he bound to reply to you? How would you comply?
Impossible.
And if you have not received a feedback from him, can I say with confidence that yes, I am completely independent? I have no basis. It's just like how we discussed on internal control. Unless there is documentation, I cannot.
In fact, you have to keep your relatives in good humor. If he wants to remove you, he can go and buy 1,000 shares of
And
this
not
company
disclose it
and
to you
not disclose
and
it
get you into trouble
and
at
write to
some
the
point.
company saying, I'm a shareholder of this company, and you will get disqualified.
Sir, you won't have a problem rotating auditors if only you could find an audit firm that does not own JSW Steel shares either through themselves or through their relatives. That's where you may run into a real practical issue.
No, and each time you have to look for a spouse for one of your children, you'll have to do an independence test. Because on the day of the marriage, on completion of the marriage, you've disqualified.
The powers and duties of auditors include commenting on financial transactions or matters that have an adverse effect on the functioning of the company. Then there's the internal financial control bogey that reappears. And auditors must also report fraud that is being or has been committed against the company. A detailed process has been laid out in the rules that requires the auditor to report any and all fraud, not just to the board or audit committee, but also to the central government.
I think the internal financial controls we spoke about earlier, a lot is dependent upon what framework is laid down by the institute.
So that we've dealt with
and
already.
hopefully we'll move forward on that. I think there is some vagueness, as you said, on financial transactions that have a material effect on the functioning of the company.
Because that could be pretty much anything which is not necessarily in the scope of audits.
That is correct. So, for example, let's say if a company does a very large leveraged M&A transaction, is the auditor kind of required to sit back and say this could have a material, adverse impact on the functioning of the company? I don't think that's the intention, and I think that's how we need to get to a resolution to say how does the auditor focus on those areas which are core to their responsibility. Fraud reporting is a challenge for a variety of reasons. Again, the way this works internationally is that at the first call, the auditor reports to those charged with governance, which is the audit committee, and only if the auditor is not satisfied with the response of the audit committee, the auditor may report to the regulator.
That's been brought into the rules now.
No, what the rules say.
You write to the board, right?
Yeah, in the first instance, you kind of write to the board, but irrespective of the response of the board, so the board may say, look, here is how we've investigated it, and there is no fraud, or there is a fraud and here is the action we've taken to which the auditor is satisfied, but that still kind of does not absolve the auditor of the responsibility to report to the central government. The other challenge we are facing in
Why is that a problem? But
yeah, the reason it's a problem because you will have a lot of items being reported to the central government, including some which ultimately are not frauds at all.
I don't know, is it such a big deal? You report to the government, let the government take the
Materiality
decision.
concept if they bring in.
Yeah.
Any fraud which has a material impact on the results which are shown or in the operations of the company, they require to be reported to the central government.
Actually, there is no distinction between fraud by the management and fraud on the management. If some fraud is happening today in the company, if it's a large company, you take every 5-star hotel, every hotel will have 2 or 3 frauds a day. It may be 5 rupees, it may be revenue stamp stealing. Now, without making a distinction between fraud by the management, on the management, by the management you report to the government, but on the management you directly go to the government and report because we have nothing else, but you have an obligation to report. So that's going to pose a serious problem. 2 is, if you get probably 5,000 complaints a day, what will you do? You can't say, I will not do anything about a fraud which comes to my notice. It's an enforcement problem. The third important issue would be that when the audit committee and the board are going to sit up and do investigation, take corrective measure, why would I go and report to the government?
Because maybe they won't take corrective measure. I don't know. I suppose it
No,
comes
but
from a deep,
I think
suspicious
ideally,
place, right?
ideally what would have preferred is report to the audit committee and board. You are not satisfied with the action taken, make the board report in the board report. Why would I run to the central government? We're trying to centralize all controls. But very critical on these issues is you have not, the materiality, according to the draft rules which are exposed, materiality was there. I understand, I'm not sure. Either the law ministry said the act says all frauds will have to be reported. Therefore, rule cannot make a deviation from the act. So I think this is a fit case, A, for an earlier amendment or for a removal of difficulties, it will happen.
It's not
So
as
in the
it's not as easy as
7 or
that.
8 episodes I've done so far, removal of difficulties has come up more frequently than independent directors, auditors.
So the whole
any
law
of
has to
it,
be amended for
governance.
removal of difficulties in a way.
Yeah, every
But
other thing
but
goes back to removal of
I
difficulties.
think it's more deeper than just an issue of materiality. If you read the section 143.12, it talks of fraud is being or has been committed. So that means if a fraud has not yet been committed or is in the process of being committed,
You have to recognize.
you have to
Yeah.
start the whole process.
But you mean you big four people can't do that?
No comment. Let me come to the second part. of it.
Give away the consultancy. How will we do that?
Let me come to the second. The second is the definition of fraud. Whilst we're all discussing, we seem to be very clear on what is fraud.
Yeah,
But if you go to section 447 and see the definition of fraud, it talks of abuse of power, abuse of position, it talks of whether there is monetary gain or loss, and does it mean a mis-selling is a fraud, does it mean if I give you a defective product it is a fraud. There are a whole host of, in the definition, the concept seems to be that auditor should be a whistleblower. If you accept that concept and then look at the text of the law, I think it's operationally very, very difficult to comply with the text of the law. We are actually, as auditors, completely clueless.
In addition to this fraud, there are also some more additional responsibilities on the auditor relating to litigations and also derivative losses, which are likely to come in future. They are also required to be commented and quantified.
So the problem
In
is
the accounts.
In the
auditors report.
the problem is every
up to
time
now
it's
it
a
is
problem.
only actual which has happened. But
Yeah,
the
now
future,
you've got to figure out the future bit. I
you
read
take
that in
a
the
view
audit report.
on
Yeah.
a derivative transaction, what could happen in future, and then comment about it.
But sir, the auditors are supermen, no?
Superman, that's what, yeah.
So that is why
Independent
additional.
directors and auditors.
Only the cape is missing.
Companies Act, a special presentation by The Firm.
The Companies Act 2013 goes one step further in mandating auditor independence. It lists a long list of activities that an auditor cannot provide to the company. Also, Section 144 explicitly bars network firms from providing these services.
The principle of, in the scope of services restrictions is that there are at least 4 threads insofar as independence. But one of the things is self-review thread. You should not be put in a position where you are reviewing your own work. And that principle is well established in Section 144 in the list of services. The only challenging issue is the term management services. If you go back to the Irani committee report listed all of this: internal audit, valuation services. It used the term management functions. It said an auditor should not undertake management functions.
Got it.
That means you should not be doing functions of the management which is outsourced to the audit firm. But that wording somewhere down the line seems to have been changed from management functions to management services, and therefore it's interpreted to mean any advisory services, and there are interpretations floating in the marketplace. Then the second dimension is when you apply it into the group and through related entities and look at global entities, it becomes impossible to comply in that way and monitor. It's not
You
easy.
said subsidiaries, associates.
and through the
extending the definition
entities.
to associate is the most difficult.
Maybe we should go back to the age of standalone audit firms, sir.
That's what's going to happen.
Is that the message this act is sending out?
Only, then you won't.
Saying let's have standalone audit firms. Let's not have audit firms that also do
sure.
consulting, that also do other advisory work.
Yeah.
Because we don't know where the conflict then creeps
Because the
in.
question
Correct.
is,
Then
We're
you
not
won't find-
sure we want to
you
be
won't
able to
find
try and
quality
figure out
people
what
in
can you bite
standalone
the
audit
hand that
firms.
feeds you? Is the question. If you're going to be dependent on a particular group
That's
for
my
a
point.
huge amount of money,
So are we pushing for?
I think we are pushing it a little too far. But principally, that can you bite the hand that feeds you is a good one that we need to look
No,
at.
that's the suspicion with which this act has legislated all these provisions.
Absolutely.
I'm saying maybe the message going out is standalone audit firms.
Yeah, I would prefer, if that was the intention, to just say it the way it is. It's always easier to deal with regulation
I get that,
straight.
as opposed to this whole.
I think here what is happening is, I think overall non-audit services, the restrictions are pretty fair. The challenge, as Ramesh rightly pointed out, and again, if we read it in the context of auditor rotation and all of that, is once again I go back to the point, because these restrictions apply to the parent company as well. So if your member firm is providing prohibited services, let's say valuation services anywhere in the world or to the parent company, you are precluded as being the auditor. Internationally, there is something which is called the not subject to audit exemption, which says that, look, some of these services, for example, if I'm doing the audit of a subsidiary but somebody else is the auditor of the parent, I can provide valuation services to the parent entity. That's not a problem, because that will never be subject to my audit. Now that kind of benefit is not available. Some of those things are coming
My
back.
only
on
point
us.
in this is already the institute had a rule. These are more self-regulation issues. Now putting it in the act is complicating the matter. When there is a self-regulation, the institute has a rule saying you can't do the following services.
Yeah.
You can't do more than 100% of the audit fee, you can't get it in other services. They were running very effectively. But I don't know why they started putting everything in the act.
Unfortunately, we're out of time again. So next week on Companies Act, NFRA, the new super regulator for auditors, and auditor liability.
Companies Act, a special presentation by The Firm.